Hey everybody, this is Boris Schlossberg with BK Forex. Welcome to our series of webinars with Pepperstone. Today's webinar is called Smart Leverage, How to Achieve High Returns While Controlling Risk at the Same Time. I just want to take a second, make sure it looks like my volume is coming through well, but just want to make sure if you guys type into your question box, yeah, everybody's hearing me well, so sounds really good. We'll proceed. Now, I'm going to go through the webinar, and you guys feel free to ask questions in the question box at any time. And then I'll stop also, and I'll answer them. But just keep asking those questions. And Marco, who's working with me, is going to help me, and we'll go through the questions one by one if there's anything that's unclear. There is a little bit of technical information that I'm going to show you, so I'm really going to go through this slowly. And if you have any questions, absolutely ask me, because this is really critical so that you guys can fully understand what I'm trying to say. Anyways, as always, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. I ask you to read this disclaimer very carefully to understand all the risks associated with trading in margin, and to seek advice from an independent financial advisor if you have any doubts. As you know, past performance is not indicative of future results, and trading forex carries a high level of risks. Now, the conversation today is really about what's coming up in Europe, because Europe now is just the latest jurisdiction in the world to lower leverage. Starting August 1, leverage in Europe for all CFD and FX products is going to go down to 30 to 1. And I think for crypto, it's going to go even lower, to like 7 to 1. But for our purposes, where we trade CFD and FX, is going to go to 30 to 1. Now, before you sort of say to yourself, well, I don't care, I'm not going to trade in Europe, or I'm going to trade somewhere else, I want you to understand that you will not be able to really escape this trend over the next couple of years, because this is a global trend by all regulators across the world to assert control over levered markets. So anywhere you turn, if you turn to Japan with the Financial Services Agency, if you turn to Hong Kong with the Hong Kong Monetary Agency, if you turn to Singapore, Monetary Authority of Singapore, and if you turn to US with CFTC, leverage is considerably lower, somewhere around the levels that you're seeing in Europe now. And it has been that way for a very, very long time. And the trend is not going to go the other way. So my point is that you're going to have to get used to succeed in a new trading environment with lower leverage. Instead of desperately seeking some, bucket shop in Nevins Island to trade where none of your money is ever going to come back to you, if you want to trade with a quality broker, almost all quality brokers are going to have lower leverage, because they're all going to be regulated by quality regulators in Europe, in Asia, in US. And eventually I'll probably be leaving even in Australia. So the thing is that you need to understand is that this is not a bad thing. In fact, it's probably a great thing. And I know this is hard to believe, and I know that I've gotten a lot of flack from traders across the world when I say this, because I don't think people really understand what this is all about. This is actually a tremendous opportunity for everybody to become much more professional in their trading. This is designed to help you stay alive rather than put you in danger of risk. If you want to understand just how good a thing lower leverage is, just take a look at this particular chart. This is a chart of the percentage of winning traders, or the percentage of winning trades, individual winning trades, depending on what kind of leverage they have. And I want you to look at these numbers, because I know it's shocking to many of you, all of you who are used to trading at 500 to 1 or a million to 1 or 10 trillion to 1, at the numbers here. But this is a very, very important graph, because this shows you reality versus illusion, truth versus fantasy. If you trade at 5 to 1 or less leverage, the probability that you have a winning trade is more than 6 out of 10, 61%. On the other hand, just going to 25 to 1 or greater leverage, you lose more than 13 percentage points. That means out of 100 trades that you make, 13 more trades are going to be losers. And remember, this is the other interesting thing. Those losers are going to be on larger leverage. So that means not only are you going to lose more frequently, but you're going to lose a lot more at higher leverage. That is the single most important thing you need to understand, is that the higher the leverage, the lower your chance of winning. So the thing you need to understand is that in the world where the regulation is very tight, for example, in Japan or Hong Kong, and in Hong Kong, regulation has been at 25 to 1, which is low. In Japan, also 25 to 1. This is lower than even Europe at 30 to 1. It's been there for decades, not just for a year or two, but for decades. So we have reams and reams of data. You know, when I was in the, with other FS brokers long time ago, the Hong Kong office was always the most profitable office we had in terms of traders, because they traded at low leverage. This is a really, really important thing. This statistic really correlates with this particular truth. The lower the leverage, the more profitable almost all the traders were. Now, the pros use much lower leverage. No professional trader ever would consider 500 to 1 levered trade or 100 to 1 levered trade or even a 50 to 1 levered trade, right? The pros use extraordinarily low leverage, generally no more than 5 to 1, to achieve their goals, because they understand that leverage, a lower leverage, protects you from significant losses. So generally, there are basically two ways to create leverage. And this is the thing that I think most retail traders absolutely do not understand, which is what I really want to share with you in today's webinar. The standard way is the broker extends you credit. If you think about what is leverage, what is margin, what is all those words, they're just synonyms for the word debt, right? I lay down $100, and my broker loans me $100 so that I get a chance to use $100 to buy something, right? It's exact same thing. If somebody said to you, hey, you want to buy a house, and the house is worth $1 million. I'm gonna use dollars because I'm an American, but we can use euros or pounds or anything else that you guys want. But you understand my analogy. Let's say the house is worth $1 million, and you say, great, I'm gonna lay down $10,000 on this house, and then I'm gonna hold this house, this $1 million property. I'm gonna pay the mortgage on this $1 million mortgage, and I'm gonna hope to flip it over and make profit on it, right? How many of you would cavalierly do that at any given time? You'd be actually very reluctant to do that, because if, let's say it took you 3 months to sell the house and the mortgage was $10,000 a month every single month, you'd just, you'd be losing money. Your $10,000 that you initially put down would be burnt out in the first month, and you wouldn't even get a chance to sell the house, right? I'm just assuming that that's all the money you have. I'm just giving this hypothetical example. So when you think about leverage, I really want you to think about it as debt, because that is really what it is. It's debt. It's nothing more than that. It is true, pure debt, which is why it's a two-edged sword. It's both a blessing and a curse. And if you don't appreciate that, don't understand it, then you can get into serious trouble. Now, the power of leverage is enormous. We all know the power of leverage. Even at something extraordinarily conservative, like 2 to 1, $1,000 invested gives you $2,000. If you make 1% on that trade, you made 2%. At 10 to 1, you've now made 10% on one single trade, which is enormous in the grander scheme of things, right? And of course, if you go to 200 to 1, that sort of hypothetical example that I was giving you where, you lay down $1,000, you control $200,000, and you flip it over, you doubled your money, right? You doubled your money, right? Which is always really enticing. And I think this is the lottery ticket attraction of leverage. Everybody goes, oh, all I got to do is lay down 1,000, and tomorrow I'm going to have 2,000 in my account. And that can happen. And that indeed is, one of the great attractions of high leverage. But here's the thing. 9 out of 10 times, it won't happen. And if I gave you the following proposition and said, okay, you give me $1,000, and 9 times you're going to lose that $1,000, and 1 time you're going to double it. Would you make that bet with me? Would you take that bet? You'd be an idiot to take that bet. It's one of the worst bets in the world. It's basically a bet that says, I'm going to lose $9,000, but I'm going to get it. But I'm going to be excited along the way. I'm going to have 1 chance of excitement along the way. And if you think about, if you're really, really honest with yourself, because trust me, I've been there. I'm not telling you anything that I have not myself experienced or have seen thousands of other traders experience, because I have seen this process amongst thousands of traders. If you think about it really honestly, most of you who are listening to me, who've sort of followed that path, have actually lost $9,000 trying to chase that doubling of the account, right? If you were to add all the times that you've added to your account because you blew out your account, and we really did an honest accounting with yourself, you'd be much closer to the idea of losing $9,000 than doubling your money. But it's so enticing. It's just so attractive. It's so beautiful, the fantasy. But it is really a fantasy. It is not a reality for almost any of us, because the markets are just not that, we're just not that lucky. We're just not that lucky, and we're certainly not that good. None of us. Now, on the other hand, if you take a much more professional attitude towards risk, you can see how control over leverage gives you control over your money. So here's just a simple, very clean, and actually very conservative table. And it assumes something that happens to us. If we swing trade, this happens to us at least once a year. If we day trade, this happens to us at least once a month. And I'm just really being as broadly descriptive as possible. In other words, it probably happens to us more, but I'm almost certain that it happens to us. If I'm day trading, which means I'm doing 100 trades a month, the probability that I will have 5 consecutive losses is almost 99%, right? Basically, in any kind of 100 trade batch, you're going to run into counter trend structure when you're trading trend, or trend structure when you're trading counter trend. You're going to have 5 of the same positions against the market, and dollar will turn. I mean, all these things happen. I would be shocked if nobody in this room has ever had 5 consecutive losses happen to them. So I chose that number specifically because it's realistic, but at the same time, very powerful demonstration of how you can spin out of control completely on higher leverage ratios. So just 5 consecutive negative trades of 1% losses, 1% stops, right? On no leverage, we preserve 95% of our capital. We start with $10,000. And again, my apologies for being US centric, but in New York, we're not even US centric, we're just New York centric here. We think the rest of the world revolves around us. Anyways, you start with $10,000, and even when, in the worst case scenario, you have 95% of your capital. Now, if you use 10-to-1 leverage, just 10-to-1 leverage, and you happen to have caught that bad string of losses, whether it's a consecutive string of losses, or whether very often I have EAs, I have robots that sometimes will open up trades, and they're all on one side of the market. So you long euro, long pound, long Aussie, right? And then the dollar turns, and boom, 5 of them go the other way. If you're trading 10-to-1 leverage, you've lost 60% you've only, 40%, 40%, my apologies, or really 41%. But basically, in one example, in the first example, you've able to maintain 95% of your capital. In the second example, exact same trades, but just higher level of leverage of 10 to 1, you've lost, you're only able to maintain 59% of your capital. It's a massive difference both as far as money goes, but even much more importantly, as far as psychology goes. And you know why it's a massive difference? Because the second component of trading is something that people really underestimate, which is the long path to recovery. The deeper the hole you dig, the harder it is to get out of it, right? The harder it is to get out of it. So if you lose 25% of your equity, it requires 33% just to get back to where you were. If you lose 50% of your equity, you got to double your account just to have the exact same amount of money that you've had before. At 75%, you got to quadruple it. And at 90%, your chance of getting back to even pretty much zero. You know, it is never in my life have I seen an account go 10 to 1, unless you take a lucky trade and have a hunch bet a bunch and you get lucky in that one trade. But the fact that you would get lucky on 10% stub of your account means that you're probably going to be, if you keep doing this, if you have, let's say, 10 times when you refund the account, one time you get it back to even, the 9 other times, it's going to blow out the 10% that is left there in a margin call, right? So these are very, very important dynamics, and I just want to go through them again just to make sure that everybody has really absorbed the critical point that I want to make, which is that leverage is very powerful. It can be a tremendous tool, but it can also be an incredibly, incredibly damaging factor if you let it get out of control. Leverage and risk control go hand in hand, both because on the first level, they help you preserve your capital, and on the second level, they make it much easier for you to become net profitable in the end, because the recovery time and the recovery path is much easier. It's much easier for me to come back when I have 95% of my equity versus where I have 59% of my equity or 51% of my equity. Because, here, I only got to make about, 6-7% of my money, right? Whereas here, I literally have to double my account. My task is gargantuan. It's Herculean in its effort. So the harder you dig, the deeper you dig, the harder it is to come back. And that's the key thing, is to basically reduce your ability to make a hole for yourself, right? To dig a hole for yourself, right? Is everybody clear on this particular part of leverage and risk control? Does anybody have any questions at this point? I'm happy to stop right now and just answer.
Yes, we do have some questions, Boris. Thank you for your time. The first question, I'm going to start from the first slide. So how long do you think until the regulation you said is going to go global? How long do you think until it goes global?
I'm not a regulator, so anything I say here is nothing but just my opinion. But it's in my belief that regulators really concerned about this, because it's just been a tremendous amount of, as everybody's aware of, there's just a tremendous amount of abuse in the industry over the 20, with some very unsavory players taking advantage of retail traders. And so regulators, I think, are going to be very concerned about this. And I think, honestly, within 2 or 3 years, we're probably going to have uniform standards where most of the world will be trading at 25 to 1, which is, in my opinion, really a really good number to trade at. You don't need any more. I'm going to show you why you don't need any more. I'm going to show you exactly why you don't need any more than that to really succeed in trading. But I don't, it's just my opinion. But I think 2 or 3 years out, we'll probably all be trading at these kind of levels, because as you can see, everybody is converging essentially on this one number. Why are they converging on this number? Because they understand, they see the records, they see the data, and they understand that this is sort of a happy equilibrium between allowing people to assume risk responsibly and making sure that they're not being taken advantage of or simply just lose all their capital in an uncontrolled fashion. So again, only my opinion. Right now, we know that Asia, Europe, and North America are all under a pretty low leverage regime, and there's zero interest in going the other way. So that's sort of my opinion. Any other questions?
Yes, we have another two questions. So we have another one that says, Boris, would you please clarify if Pepperstone has an interest in pushing ESMA regulation? This is really not clear to me.
No, Pepperstone is a fully. I don't want to speak for Pepperstone, but the point is that this isn't a choice. Anybody who wants to be in a regulatory environment, and let me ask you the question the other way around. Would you rather trade with somebody who's regulated, where you have tremendous amount of faith that your capital is secure and that it's well positioned and you're running an honest market? And if you want that opportunity, then anybody who's trading in Europe is going to follow those rules. And these are rules that are being followed everywhere. Even in UK is following these rules. UK is following the ESMA rules. So this isn't a broker dependent policy. It's a global. It's a continent-wide policy or region-wide policy that is that everybody's going to follow. Go ahead. Any other questions?
Yes, we have another one. This is a really good one, I think, and kind of long, but I want to read it to you. So with leverage, I understand why we would say risk, say 2% of our available margin at a time. But what do you think about risking 2% of your initial investment at a time, which then negates the actual risk control? For example, I would trade a lot of the time, every time for the same volatility, no matter what my remaining capital is, as long as it is a percentage of my funds, of course. I don't know if you want me to reread this. Or...
Yeah, if I understand the question, the trader is asking, let's say I have $10,000, and again, I'm going to use a U.S. example just because, bear with me. And every trade I make, and this is a really good question, really good question, because I'll explain in just a second. So for $10,000, every trade I make, I'm going to risk 2%. So if I have $10,000, I'm going to risk $200 on a trade. Just that it's going to be a money risk. It's not, it's just a money stop. If the trade goes $200 against me, I'm out, right? But let's just say now I have $8,000 in my account. I've had a bad month. The account is down to $8,000. Now I'm still going to use the same 2% rule, and now my maximum risk is $160 per account. And that's what I'm going to be risking. So before I had a little bit more money, I risked 200. Now because I have a little bit less money, I have 160. Let's just then go a couple of months forward. I'm doing really well. Now my account is $15,000, and I'm still sticking to the 2% rule. But now I can afford to risk $300 per trade, dollars, right? Which means that I can size the lot size accordingly to my dollar risk. That's exactly how you should be trading. You should have a uniform, and it's probably, I think, better to think of it for traders. I think it's much better to think of it in terms of money than in terms of percentage, because I think people kind of get a percent is sort of very abstract, right? It's the same idea, but percent is very abstract. You don't quite know how much I should be risking. But the point is, if you risk, and 2% is really, to me, the maximum I would want to risk, and that assumes that I'm doing swing trades. I'll get into my suggested risk parameters. I'll get into that in just a minute. But but the broad idea of uniform amount of dollar risk, depending on how much money I have, relative to how much money I have, is exactly how you should be trading. So hopefully I answered that question. Does that make sense to everybody?
Yes, that made perfect sense. I think that was the question. Yeah.
Okay. So here's the thing. This is the standard way of thinking about leverage, right? Here's what I wanted to show you to kind of entice your taste buds a little bit. There is another way of levering your account, which is much less risky and I think much more intelligent. We call it the smart way of leverage, which is through turnover. What is turnover? What is turnover? Turnover is basically how the most profitable retail businesses like Amazon and Zara make their money. Some of you may be in the retail business and will understand it right away, but for those of you who are not, basically the idea is this. You have a fixed amount of capital, right? Let's assume I'm Zara, and I have a little store, and I have $10,000 to buy my inventory. And I'm going to buy $10,000 worth of blue jeans into Zara on Monday. And what I'm going to do is I'm going to try to sell every one of those blue jeans by Friday. I'm just going to try to get rid of them all. I'm going to sell it for as cheap as I can, create great leverage, create great, create great sales, promotions, stuff like that. The whole point is move the inventory out the door, right? So here's what happens next. Come Friday, that $10,000 that I initially invested comes right back to me, right? Because all that money, I've sold all my inventory, so now the money is back. Now I can take that same $10,000 and go buy $10,000 more of blue jeans and put them back on my shelves. This is, by the way, exactly how Zara became the single greatest, biggest, most profitable retailer in the world. This is the trick. This is why the guy who runs Zara is one of the wealthiest men in the world. Okay? It's called inventory turnover. And if you understand the mechanics of this, let me just sort of explain it. You have 10,000 euros or dollars in an account, right? As a trader. You trade no leverage. Your trade size is 10,000 units or 1/10 of a lot, right? And you make 10 trades per day. The thing that I know about all of you, including myself, yours truly, is that most of us active traders, actually, the statistics show, we actually make between 10 and 20 trades a day, Yeah, we all talk a good game about how we're going to do one positional trade and watch it, per week and so on and so forth. Let's be real. We're not investors. We're traders. We're not here to babysit a Berkshire Hathaway account for the next 35,000 years and not do anything. We are here to trade price, to move. And that generally means we're in and out of the market at least 5-10 times a day. So here's my point to you. If you just assume that you've done 10 trades per day at no leverage whatsoever, guess what you just did? You just flipped over 100,000 units of product. You just achieved 10 times leverage without assuming 10 times risk. Instead of doing it all in one trade, kind of like, have a hunch, bet a bunch, maybe I get lucky, maybe I'm going to get killed. You've distributed that risk into 10 separate units. So your risk is tiny, but your ability to make money is not, because you flipped over that inventory over and over and over again, right? You've basically achieved 10-to-1 leverage without any margin. Cash on cash, as we say. Let me stop here. Just let you guys sort of absorb this whole point, and let me know if there's any questions here. Does everybody understand what I'm saying? If you do 10 trades same day, it's the same thing as if you did a 10-to-1 leverage on no leverage whatsoever.
So we do have a question here, even though it's not on the 10 trades, but it's a very short question, but I think it needs to be answered.
Yeah.
And it's, how does risk vary with the level of leverage? I think you did answer that, but it wants a little bit more clarification.
Yeah. So, I showed you this leverage and risk control, and you can see that if you have 5 consecutive losses and you're trading no leverage, the example I just gave you, let's say I had the same example I just gave you. We have $10,000 in the account, and I have 5 losing trades today. I made 5 trades today, right? At the end of the day, I still have $9,500 left. But if I did the same 5 trades at 10-to-1 leverage, in other words, each trade was 100,000 units instead of 10,000 units, right? I would only have $5,900 left at the end of the day. And you know what? I know so many of you, including me, myself, yours truly, who've been in that position where you blow through half your account in one day because you used high leverage. If you want to understand why the money goes away so quickly, it's because of this particular thing. It's because of this particular thing, this particular dynamic. If you want to make sure that you don't lose control over your money, move over to this side of the ledger. Trade lower leverage, you'll have much greater control. Even at 2-to-1 leverage, right? 5 consecutive losses, you still keep 90% of your money at the end of the day. That's significantly better than a higher leverage. So that's really what's happening. So what I'm arguing to you is that you don't need to even lever. You don't even need to lever. If you're going to do frequency, frequency is your leverage. Frequency is what allows you to create leverage without assuming the type of risk that we're talking about. So in smart leverage, you focus on size of trade rather than available margin, right? What you basically say to yourself is, okay, I got so much money, I'm going to trade so many times. What should be the size of my trade given how much money I have and how many times I'm going to trade? So these are some suggestions. Now, let me just sort of, before I go into my suggestions, ask Marco, is there any additional questions that about?
I think we're covered. You can keep on.
Okay, so if we have that $10,000 hypothetical account and we know we're going to do frequency trades, what should be my size? And again, these are just my own personal suggestions. Please use them, at your own discretion and decide what is appropriate for you. I've sort of created this in as easy fashion as possible to give you an idea of what I think is responsible and appropriate. So if I'm doing day trades, right? I consider, and I really create this idea about how much would I consider to be a risk. If I'm risking between 20 and 40 pips per trade, right? And generally in my personal situation, I never risk more than 20 pips per trade. So these are day trades. So if I'm somewhere around this particular stop, if my stop is around 20 to 40, I'm going to do a lot of day trades, right? The absolute maximum size per position that I really want to do is 3 times equity. So if I have $10,000, I want to trade maximum per trade. So if I open up a euro, it's 30,000 euros. If I open up a pound, it's 30,000 pounds. If I open up a yen, it's 30,000 yen. It doesn't mean, I just want you to understand, it doesn't mean that I can only open up euro or only open up pound. It's just that for one single trade in my sequence, this is the maximum amount that I think is responsible that I can open up. So it's 3 times equity, which means that basically you're risking $3 per pip as your maximum risk on a day trading basis, right? If I am a swing trader, and I define swing trading by my stop, not by my length of time, but how big is my stop. So if my stop is somewhere between 70 and 150 points, 150 pips, then I want to have a maximum risk of about 2%, because it's a swing trade. I'm assuming it's going to be less frequency, right? Here, it's a day trade. I assume there's more frequency, so I really want to limit my loss per trade to no more than 1%, which means that maximum pip size is $3 a pip. Here, because I'm going to be less frequent, because it's swing trades, I can give myself a little more room, give myself 2% of account, and therefore trade $1.5 per pip on a 150-point stop, right? Big stop. So it's really a question of what are you trading, how big is your stops, and how big is your account. And it's up to you to decide what is reasonable. But these are just my suggestions but what I think is an intelligent approach to risk. It's really what it's all about, right? Personally, I trade with no leverage on a day trading basis. So my risk, just, you don't take me as I trade like a grandmother. So, take me with a grain of salt. But my own personal risk tolerance is this. I trade 20-point stops. I will do between 8 and 12 trades a day. So there's a lot of frequency. And because there's a lot of frequency, I never trade more than 1 times lever. So for $10,000 in my account, I trade 10,000 units per trade. Now, right now, for example, I have Euro Open, Pound Open, Aussie Open, right? Each one of those is 10,000 units. So my total amount of units is 30,000 against a $10,000 account. But that is, that is my risk tolerance and my risk structure. And even that, trust me, even that can give you a heart attack if you're on the wrong side of the market. But that is, like I said, I trade like a grandmother. You can go higher. I sort of put these as what I think is maximum prudent structures. So let me stop here again. Make sure everybody's absorbed all of that as an idea. Is that clear? No questions, Marco?
Yes, we do have a question.
Okay.
More than a question, is like, I think it's something that is not clear. So you said you trade like a grandma, but the question that the guys have is, so is your reward very small as well, or not?
Is my what?
Is your reward very small as well, or is it or is it not?
Is my reward very small?
Yeah.
Yes. I look to make 20% per year on my account. And that would be extraordinarily good. I'll be very happy with that. Now, that's a completely different conversation. I don't want to, I really, because, and maybe I think it's really, actually, you just gave me a very good idea for a second webinar. We're obviously going to do a webinar every single month. So maybe I'm going to do a webinar in 2 months from now. Maybe that's a conversation we should have in 2 months from now, as to what is a realistic reward and why small rewards can actually make you a lot of money. That's probably a really great conversation to have. So I don't want to get into it, but yes. If you're looking to double or triple your account, you're probably not going to be able to achieve that with this particular risk structure, but you're never going to be able to achieve that anyways. So, I mean, you'll achieve it and then you lose it all. So, my point is that if you want to do this for a lifetime, not just for a week or for a month, this is the way to go. We'll get to that conversation in another webinar. It's a really good question about what is a realistic reward. But you're absolutely right. The reward is going to be much more muted. But it's going to give you much better rewards down the road. I'll show that to you in another webinar. Anyways, so 3 ways to lower leverage can make you more profitable. You can think like a real trader, right? It gives you more patience. Another thing is, remember, if you are trading on low leverage and you're in like this position, like last week I was in dollar yen. I was short dollar yen, and the thing just went up my throat, right? Like literally up to my neck against me. I think I was short in the 12s. It went to like 13. It went to within 10 points of my stop, right? Now, if I was at a very high levered position and it was going up against me, I'm almost certain I would have stopped myself out, out of sheer pain, pretty much at the top. But because I was in at a reasonable leverage, because I still had serious, conviction in my trade, and because I really was much more relaxed because I wasn't levered out of my account, I was able to hold on against some very, very negative price action until Friday. Everything collapsed, and yen, yen went my way, and we were able to cover for profit. So very often, low leverage is not just a function of mathematics, but it's a function of psychology, which is in many ways much more important. I was listening to a podcast the other day from a trader. He said something really important. He said, we all focus on mechanics, and we always forget that the single most important aspect of winning and trading is psychology. And this is one of the most important aspects of helping your psychology is to trade at lower leverage, where you don't feel this kind of throat constricting pressure because margin is about ready to kick you out. So you have greater focus on steady and consistent returns as a result. So these are the really positive values of lower leverage. And again, as I said, trust me, if you want excitement, if you do a lot of trades a day, you're going to have excitement. There is no dearth of excitement when you're doing 10 trades a day, even at low leverage, because there's always risk. The markets are always a pain in the ass. The markets are always doing not quite what you want them to do. And trust me, you're going to get, you will have days where it'll be a real challenge. The difference is you're going to survive those days. On the other hand, you'll also have days like I had yesterday where every single trade was a winning trade. Like here's a, where's my, if you look at yesterday's, let me show you. Look at all my trades yesterday. We'll just start over here. 7, 8, 7, 4, 1, 8, blah, blah, blah. You have these incredible runs. I had 80 points in my account yesterday, and all of it low stress. Today, not so good. The market is not cooperating with my strategy, but I'm not dying. I'm nowhere near dying. I'm just having a bad day. That's the difference between trading with low leverage and trading with high leverage. I'm never, it's just a bad day at work instead of a getting fired. Basically, this is actually a really good analogy. Low leverage allows you to have a bad day at work. High leverage pretty much assures you that you're going to be fired from your job within a week. How's that for an analogy, Marco? As a trader, because that's really what I think it comes down to. Now we have a couple of minutes, so as always, I love to share my strategies with you guys. So I wanted to share with you this particular strategy that did so well yesterday, and show you the basic ideas behind it. But before I do that, let me just pause again and make sure that everybody understands, or if there's any more questions regarding what I've just said.
Yes, we have one question that's actually really interesting. So you talked about the 10 trades with the 0.01. So we have a question that says, what if our trading style doesn't tolerate a lot of trades per day? This will possibly force us to change our way of doing?
Perhaps he can show me specifically how, the question I have for the trader, and he can come back to me later, is how many trades a month does he do? How many trades a month does he do? Right? It's always a combination of frequency and size, right? So I'm addressing what I think is about 95% of the audience, which is everybody who trades FX, usually does between 5 and 10 trades a day, right?
So it could be 10, 12 per month?
Yeah, how many trades per month does he do?
10, 12?
10 trades per month. So there's 100 trades a year. There's 100 trades a year, right? Under that scenario, I think it's reasonable for him to maybe use 5 times leverage. And again, I'm assuming he has about 100-point stop on trade. Let me just clarify that. What is his typical stop on a trade? Because if he has like a 500-point stop on a trade, then that's too much leverage also. But he's actually sounds like a prototypical swing trader.
It's a variable ATR stop. That's what he uses.
I need pips. Okay, don't give me the variable ATR. Give me a freaking pip number. I don't care if it's not precise. I can't help you if you start getting cute with me. I need actual numbers. I'm going to assume you do a 100 pip stop. Okay, variable ATR. ATR is about 100 pips for any major pair, give or take 10 or 20 pips on either side, right? So at 100 pips per risk, and you have 100 trades, right? 5 times leverage, in my opinion, this is just my opinion, is maximum. So what that means is the most you're going to lose on a trade is 5% of your account per trade, right? Now, you could say, I have $10,000. I'm going to do a $100,000 euro trade. That's 10 to 1 leverage, and I put an ATR stop, which is 100 pip stop, right? And so one trade now it's 9,000. 2 trades, now it's 8,000. 3 trades, now it's 8,000. That's it. You're getting clipped. Remember, I said 5 trades in a year, negative trades, is very possible. So if you use 10-to-1 leverage and you have a 100 pip stop, there's a very strong probability that you will lose half your account, or you'll take your account down to half. Now it's fine if you're fine with the idea of like I can tolerate my account going from 10,000 to 5,000 because I'm willing to take risk. That's fine. But my suggestion to you is the maximum you should do is half that at 5-to-1. That's maximum. Me personally, I would trade no more than 2 times leverage, right? Because what we found out psychologically is that once people lose more than 20% of their money, so once your $10,000 account goes down to 8,000, you give up psychologically, and once it goes down to 7,000, your chance of coming back is almost zero. Okay, it's got nothing to do with math; it's got everything to do with psychology. So those are really, really important things. So, anyways, that's just my personal opinion from the School of Hard Knocks. You can take it or leave it, but hopefully it gives you some sense of why and how these things work. Does that make sense to everybody? Any more questions, Marco?
I think we're fine. We can keep on.
Okay, super. So let me take the last 10 minutes, kind of a quick review of the day trading strategy. And by the way, the strategy I'm about to share with you, I'm sharing it with you on 1-minute charts. It's completely scalable and completely doable on much larger charts, like hour charts or 4-hour charts or daily charts. You could do this on any charts. I'm a day trader by heart, and so I'm showing it to you on the smallest possible time frame. So what we're looking for here is a chart setup to trade trend where we buy higher lows or sell lower highs, right? And we do this with a couple of just 2 very simple indicators. We use the simple moving average, 500 periods, and Bollinger Bands, standard 20-period SMA, 75 basis points SDA. The normal Bollinger Band settings are 2 standard deviations. Here we're making very, very tight standard deviations around the moving average, 75. So only long trades if the 20-period SMA is above the 500-period SMA, only short trades if the 20-period SMA is below the 500 SMA. That's it. We trade this only on the majors. This only works on the majors, does not work on the crosses. Don't even try it, okay? Because majors are the only ones that have any kind of trend capability. And what we're looking for, and again, my own structure, you're welcome to completely and totally dismiss it or change it or change the risk rewards. I have a very negative risk reward because I look for an 80% accuracy win ratio. High probability structure, 20-point stop, 8-point take profit. So 20 risk, 8-point take profit. If it goes +7, I move my stop to +1. All of this, by the way, is of course done by a robot. I think it's very difficult to do this on a point-and-click basis on a 1-minute chart. It's not at all difficult to do this on a 1-hour chart or a 4-hour chart where you could make your take profit is 50, 60 points. You have lots of leisure. Your stop is maybe 100 points, and your take profit is 40 points. So you have lots of leisure to manage the stuff. But on a short-term basis, you really need a EA to run this. And so on the long side, the rules are this: 500 SMA above 20 SMA. Price dips below the lower Bollinger Band and then close above the lower Bollinger Band. We set a reference point 1. Price dips below lower Bollinger Band and closes above lower Bollinger Band. Again, put a reference point 2. I'll show this to you visually. You'll see right away what I'm talking about. If reference point 1 is bigger than reference point 2, then we buy the market. So here's the chart. Let me go to full view so you guys can really see this in full detail, right? So this is what? British pound, right? Here's the 500-period SMA. Here's the Bollinger Bands with a 20-period SMA, in the middle of them, right? The price comes in until the lower Bollinger Band comes back out. Like, in other words, candle dips in, closes, then closes back up above into the Bollinger Band. That's reference point 1. What is it really? What is it that we're really looking for? Is essentially a visualization of a swing low. This is a swing low, right? boom, boom, swing low. Now price marches on, marches on, marches on. It comes back out, dips again, from the lower Bollinger Band, comes back up, lower Bollinger Band. Another swing low, right? Reference point 2. What we are trying to establish in a trend. Remember, what is the essence of trend? Trend is defined by an uptrend is defined by a series of higher lows. Is this low lower than this low, or is this low higher than this low? Is reference point 2 bigger than reference point 1? The answer is yes. Trade. Boom, 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 and we get trend, and we and the trend is confirmed, and we trade trend, and we make our money, right? Now, if we want to do the other way to trade trend is to buy breakouts, buy higher highs or sell lower lows, right? So same idea, same pairs, same potential structure, but now we're gonna do this on a momentum basis, and we're going to sell lower lows. Here's a short example. This is dollar yen. Again, 1 minute chart, right? So first, Bollinger Bands come in here and they break into the lower Bollinger Band. We're short. We're only taking short trades. So this is our reference point 1. What is the value of this particular candle close? That's one value. Now it goes back up, and then boom, comes back down and breaks the lower Bollinger Band again, right? Breaks lower lows, makes another lower low. We're effectively making a lower low. Low, lower low. By making a lower low, I have strong confirmation there's trend to the downside. I short over here. It's a momentum short, and it goes against me a little bit, and then boom, it takes my trade into action. So it's essentially 2 ways of trading, and honestly, I don't have. It's not like I prefer one or the other. I think both of them are really valuable. What I do right now is I do the first method, which is I try to buy higher lows in an uptrend, sell lower highs in a downtrend. But I'm fully open to the idea of selling lower lows or buying higher highs as well. There are advantages, disadvantages, to each one of those trends. In the way that I do it now, you get in earlier, you get a better price entry. The disadvantage of that is, it may not be confirmed as a trend, right? It just certainly could make a higher low and then fall apart. When you're making higher highs, there's more indication the trend is really in place. Or you're making lower lows, there's more indication that there's more selling going on. So you give up a little bit of price value for a higher degree of confidence of direction, right? Trade off the other. I don't think, honestly, it's 6 of one, half a dozen of the other, especially on the 1 minute charts. So I use the first method, but you really can use both. We keep it simple. I keep it a trend. I don't leverage, and I sort of follow Buffett's rules of investing, which is don't lose money, and I stop myself out every single trade, and no trade ever is good enough for me to stay in if it goes beyond my stop, right? But here's the last thing, and this is really, I think, the single most important thing about this strategy, and this is the single most important thing about trading, period, especially on a day trading basis that most people forget, including yours truly. I am just as guilty of this as anybody else. But this is really the single most important thing that makes this strategy either profitable or not, which is that, and this is another kind of a advice from Warren Buffett. He said that really successful people say no to almost everything. And what that means is you actually want to say no to many more of your day trades than you do. If I limit myself to just 1 trade per trend cycle, so only when the 20 SMA crossed the 500 SMA, that first cycle, not the continuity, like sometimes the trade can go continuously for a couple of hours and it'll make higher highs, higher lows, right? But just that first crossover, and when I get that set up, if I take that first clean signal of their setup, my probability is much higher than if I continue trading in that particular trend. Because remember, inevitably, especially in FX, but in almost every leveraged instrument, the trend will end. And inevitably, what you're going to do is you're always going to just press your luck until the last point where you hit a bad trade. And the whole key to this strategy is to avoid bad trades as much as possible, right? If you can just avoid the sour trades, all those little profits really add up. So the way you avoid the sour trades is just by keeping yourself disciplined to just one cycle per trade. If you can do that, it works. Here's a cycle where boom, boom. The first trade you take, that makes money. The second trade you take, this is your cycle starts again. Reference point 1, reference point 2. You take this trade, and actually it never goes to profit, and actually comes in and stops you out, right? This happens all the time. This happens all the time. Price just does not universally go up in one direction. Very rarely, 1 out of 10 days, do you get a move where you just get every single higher high or higher low. But most of the time, it's like a one burst, and then it's a retrace. And if you just keep yourself to that one burst, you will keep yourself in a much better long-term position. I wrote a column about this. You guys are welcome to follow me on Twitter and read my columns. But it talks about the idea of never drink at a Las Vegas table. And the idea was that casinos love to give you, especially, well, it's interesting, European casinos don't do this. They're cheap bastards. I was really shocked, by the way, the Europeans don't do this because they're so cheap. They don't even understand why it's so important to do this. But in Las Vegas, they're more than happy to give you as many free drinks as possible while you're gambling with them, because that's their way of keeping you at the table. They know that the law of large numbers means you're going to give away all your money because the edge is on their side. Well, the market is a very similar way. In the long run, the edge is always on the market side. There's only small pockets of possibility where the edge is on your side. And your job is to come in, take advantage of those pockets, and get the F out, to walk away from the table. So this is sort of my way of walking away from the table by keeping myself only to one trade per cycle. That's sort of how I do it. Okay, I think I ran a little bit over time, or just in time, but let me know, guys, if you have any questions. I'm happy to answer them.
So we have one last question. So it's actually from the same guy who actually asked the nice question before. So it says, Boris, how do you calculate your trade sizes? Do you have a reference paper with like your 20-40 pips risk, depending on the currency exchange for that day, and the correlating trade sides, or is there a magic calculator too?
No, you need to know your risk, and I gave you my suggestions. So I gave you my suggestions of what I think you should be doing. If you want to keep it very simple, I'm terrible at math, and I really don't calculate sizes at all. I just keep it really, really simple. I keep all my trades at 1 times lever, right? So as I said, if for every $10,000 in my account, my trade size is 10,000 units. Now, but I'm very conservative. So my whole point to you is just instead of you getting crazy with trade sizes, if you're day trading and your risk is anywhere between 20 and 40 pips per trade, and you're doing anywhere between 5 and 10 trades per day, right? Then your trade size on a $10,000 account should be anywhere between 10,000 to 30,000 units. That's how you keep it. If you want to just keep it simple, just trade, trade 20,000 units. Just if you have $10,000 in your account, you want a little action, you want a little juice in your returns. Trade twice your account size. So if you have 5,000 in your account, each individual trade should be 10,000 units. If you have 10,000, each individual trade should be 20,000 units. If you have 100,000, each individual trade can be 200,000 units. Okay, that's just a simple shortcut instead of you getting crazy with a calculator. Because trust me, none of that is important. It doesn't matter whether it's 2.5 or 1.5 or 1 to 0.75 or it's a Fibonacci ratio. None of that is going to make you profitable. Focus on what matters, which is the setup. Focus on the setup. Focus on the entry, focus on the exit, focus on the risk. Keep this piece of it as simple as possible. If you don't think about this, that's the best thing that could happen to you. And the best way not to think about it is to keep it at either 1 or 2 times equity. Okay? So ironically enough, it's a very important webinar that absolutely shouldn't matter at all in your overall trading, is what I'm saying to you. Because none of this is all about making sure that you stay alive in the game. That's what it's designed for, right? None of this stuff matters about how you're going to be successful. The success comes from picking trades and picking setups. But this is so important because it's what keeps, it's like breathing. Nobody cares about breathing, right? But without it, we'd all die. So this is sort of the breathing function of trading. I'm coming up with some amazing analogies today, Marco. You know, the whole fire yourself and, having a bad day, breathing. I love it, you know?
It's great.
I'm loving it. But yeah, I mean, hopefully that makes it a lot easier for you guys to understand what and how we do this. Okay. Any final questions? Anything else? I'm happy to hang out. If not, as always, you know, email me at contact@bkforex.com, right? Marco will have the video and the PowerPoint. I'm sure will be up there when you guys are ready. And everybody trade with Pepperstone. We love Pepperstone.
Thank you. And I think that was the last question. So thank you very much for your time. You've been fantastic.
Thank you so much, guys. I will see you in a couple of months. All right, take care.